Next, question 4b. Now question 4b is a new kind of question, not there in my book, but it is a question from chapter 2, cost of capital, and trust me, it is a very basic level question of cost of capital, very basic primary level of cost of capital. Let's see. TSC Box Limited is a manufacturer and supplier of Android set-top boxes for various DTH operators. This is very popular with the operators as it converts normal TV to smart TV. ठीक है? To ensure supply of good quality products to meet expectations of viewers, it has set up quality control department. So the company already has a quality control department that regularly conducts quality inspection and submits its report to the management on a weekly basis. As per the latest quality inspection report submitted by the department, it reflects that current rejection rate is 7%. Current rejection rate is 7% of the units input into the manufacturing system due to poor quality. Now total 3000 units of input go through the process every day, out of which 7% is rejected. As per analysis, for each rejection, there is loss of 150 to the company. So for each rejection, they have 150 rupees loss. Now what does that loss refer to? You are not told. Forget it. You just need to know that the rejection is costing 150 rupees to the company. Maybe 150 is the rectification cost. Maybe 150 is the net scrap value, net loss after the scrap value that you get. Whatever. For each rejection, the company is having loss of 150. The management is very much worried due to the high rate of rejection of input. Further, the management has asked for suggestions from quality control department in this regard. The department has suggested implementation of some new system of inspection for early detection of defective units. Now they suggested some new system because of which they will be able to detect the defect early. Okay. This change would result in a drop of rejection rate to 4%. From the earlier 7%. So in my present system, rejection rate is 7%. Proposed system, rejection rate will become 4%. But the cost of new system will be 12,000 per day. So you notice everything given in this question is given in terms of per day. You are supposed to analyze the proposed new system, analyze proposed new system for inspection and suggest if it is beneficial for the company. Okay, so that is simply a practical question. We'll do some calculations. Let me show that here. Present situation, your rejection is 7% of 3000 units every day, and it is costing you rupees 150. So 3000 into 7% into 150. It's costing you rupees 31,500 per day. Everything here is per day. And proposed in the proposed system, my rejection will be only 4% of 3000 units, will cost me rupees 150, plus I will also spend for the new system 12,000 rupees. New system itself is costing me 12,000 per day. Let's see how much does that become. That is 3000 into 4% into 150 is 18,000 plus 12,000 cost of new system. Total cost 30,000. So is the proposed system advisable? Yes, definitely. Proposed system is advisable. Your answer to part 1 of the question is that yes, the new system should be implemented. Simple advice here. They're asking analyze the proposed new system. We analyzed and suggest if it would be beneficial. Yes, the new system is beneficial because new system will save your net cost by 1,500 rupees per day. Done? Yes Okay. And second question, also calculate minimum reduction in number of rejections each day up to which the proposed system will be beneficial. Look, right now your rejection rate is decreasing from 7% to 4%. If the rejection rate is decreasing to 4%, I say new system is acceptable. I said that, therefore new system is acceptable. But what if the new system decreases my rejection not up to 4? What if it decreases my rejection only up to 5%, only up to 6%? Then would the new system be acceptable or not? Well, that is why now they are asking that minimum how much reduction in that rejection rate should be there for the new system. So simple, this is what I evaluate. Say my present cost is 31,500. If new system is implemented, then the cost of new system, my new system cost itself will be, cost of new system is itself 12,000. So under the new system, maximum rejection cost you can afford is 19,500. Yeah, 19,500 is the maximum rejection cost. Maximum rejection cost affordable is 19,500. Now what is the cost of each rejection? 150 per unit is the cost of each rejection. Divide by 150, divide by 150, it gives me 130 units. What does this indicate? This is therefore maximum rejection units affordable. Maximum rejection units affordable is 130. 130 out of 3000 input. 130 out of 3000 units input. Now 130 out of 3000 is what percent? 130 divided by 3000 is 4.33%. This means that maximum rejection affordable under the new system will be 4.33%, because under new system, if your rejection will be more than 4.33, then your total cost will be more than 31,500. Yes, so present cost is 31,500, meaning maximum total cost of new system affordable is 31,500. Let me put it that way. Maximum affordable total cost of new system is 31,500, because present cost is already 31,500. From that, cost of new system 12,000 I minus. So maximum rejection cost affordable in a new system is 19,500. Divide by 150 per unit rejection cost. So maximum rejection units that I can afford in a new system is 130 out of 3000. So maximum 4.33% rejection rate is affordable. This is my answer to second question. Minimum reduction in the rejections. Now they are not asking number of rejections, they are asking reduction in the number of rejections. So maximum rejection rate you can afford is 4.33. So your reduction required is from 7% to 4.33%. How much is the reduction required? 7 minus 4.33, 2.67%. Minimum 2.67% reduction in rejection rate is required. Minimum 2.67% reduction should be there in your rejections here. Done? Yes. That is your question 4B. Total 3 plus 2, 5 marks. Next question, question 4C is a good question, interesting question. Question 4C is a question similar to my classwork question in transfer pricing chapter, but this has certain new things. Because of that new things, this question becomes pretty much typical, and well, in my opinion, I would say that in the entire paper, this is the only question which was little typical, which was little difficult. Rest all the questions, even the new question that I have shown in red, are very easy questions. You saw that these 4A, 4B were actually very easy questions. Only typical question is this question 4C. I'll say question 4C was a new kind of question in this paper. We'll discuss that. And for this question, I will show you a separate working in my solution here. First, we'll read out the full question. Chrysler Limited makes 3 products X, Y, and Z in division A, B, and C. Division X is currently working at 60%, Y is working at 80%, Z is working at 100%. Okay, I'll just write that here. X is currently working at 60%, Y is currently working at 80%, and Z is currently working at 100%. Okay, of the total production capacity. Okay, now if you see the table below here, you are given details of division X, Y, and Z, and later on you are given total production capacity also. Now X is working at 60% of total production capacity, meaning X is currently producing 60% of 15,000, that is 9,000 units is current production of X. Y is currently producing 80% of 5,000. The current production of Y is 4,000 units, and current production of Z is 100% of 2,500, that is 2,500 units. Okay. Further, you are given direct materials in X 10 rupees, Y is costing 25, Z is costing 35. But notice in Y and Z they say that this material cost is excluding material X. This material cost in Z is also excluding material X. Now that gives you a hint that in this company the 3 divisions are not like a consecutive division. It is not like a continuous process. It is not like X. It is not like X transfers to Y and Y transfers to Z. No. In fact, here in this company, X transfers to Y and X transfers to Z. Your division X is transferring materials to Y as well as Z, because you notice here that both Y and Z are using material X. Okay. Labor and other overheads, your variable overheads you are given. So let us identify variable cost. In division X, variable cost 10 plus 6 plus 2 is 18. Division Y, variable cost excluding the transfer cost is 25 plus 8 plus 3, that is 36. Yeah. And division Z, 35, 10 and 4 is 39. No, 35 plus 10 plus 4, 49, sorry. Okay. Total production capacity for each division you are given, and external demand in each division you are given. So notice, for division X, capacity is 15,000 external demand is 7,500. So naturally they must be doing 7,500 units external sale. But total production of X right now is 9,000. So what does X currently do with that remaining 1,500 units? Production is 9,000, external demand 7,500, meaning presently X is doing 1,500 units transfer. Done? Okay. Division Y. Production capacity 5,000, external demand is also 5,000. So they are able to do 5,000 units external sale. They can do 5,000 units external sale, but currently they are doing what? Currently they are doing only 4,000 units external sale. Okay. Division Z. Capacity 2,500, external demand 3,000. So how much external sales can they do? Can they do 3,000 external sale? No, they don't have capacity. Maximum external sale they can do is 2,500, and currently what they are doing is 2,500. So Z has already reached its maximum sales potential, but Y is presently selling only 4,000. Maximum it can sell 5,000. Done. Further, you are given selling prices for external customers. Accordingly, you can get the contribution rate also, but that will do later. Further, the company has to incur additional fixed cost of rupees 9,000 for using every 10% of idle production capacity. Now this is new. This we did not have in our classwork question. They say that they have additional fixed cost of 9,000 for using every 10% idle production capacity. And production capacity cannot be enhanced beyond the total production capacity. Okay. Now this means what? This means that if X is currently operating at 60% level, if they wish to operate at more than 60% level, then for every 10% extra production, they will incur fixed cost of 9,000. What is idle production capacity of X? Idle capacity in X is 40%. Out of that 40, for every 10% extra production, they will incur 9,000 fixed cost. Similarly, division Y has how much idle production capacity? Division Y idle capacity is 20%. Out of that 20, for every 10 and 10 extra production, 10% extra production, they will incur 9,000 rupees fixed cost. Maybe that is why division Y is operating at only 80%, because if they produce 1,000 units extra, then they will incur 9,000 plus 9,000, 18,000 extra fixed cost. You need to evaluate whether it is advisable for them to produce extra or not. Done? Okay. Further, X can be used as input material for Y and Z. Now this clarifies my earlier presumption. This clarifies my earlier presumption that X is supplying material to Y, X is also supplying material to Z. X is available in the market at rupees 30 per unit. Each unit of Y and Z need 1 unit of X as their input material. Now market price of X is 30. So it seems that maximum TP that buyer would be ready to pay is 30. But no. There are other details also to identify maximum TP. Let's read. X supplies the product without any defects, error-free, for direct use at the shop floor without any further quality inspection to Y and Z. If Y gets transfer of material from X, it can be directly used. Because X is giving the material without any defects, so if Y will get material from X, then Y can use it directly. But if it buys from outside vendor, it has to pay 30, market price 30, plus quality inspection charge of 2 rupees. Now this makes me understand maximum TP. This is giving me maximum TP that Y is ready to pay. That for division Y, if it buys from outside, then it has to pay 30 plus quality inspection charge of 2 rupees, meaning maximum TP that Y is ready to pay. Maximum TP that Y will be ready to pay will be 30 plus 2, 32 rupees. This is something similar to what we had done in our classwork question. Yeah. Similarly, Z. If Z gets the material from outside vendor at 30, Z can get material from outside vendor at 30. But if it will buy from X, in case of Z, if it buys from X, then it has to slightly alter the product X, which will cost rupees 3 as alteration cost. So in that case, maximum TP that Z will be ready to pay maximum TP that Z will be ready to pay will become what? It will become 30 minus 3. It will become 30 minus the alteration cost. Remember your formula for maximum TP, market price, total cost of ready material minus the cost to make transferred material usable. Here 3 rupees is incurred to make the transferred material usable. It is alteration cost to make the transferred material usable. Hence my maximum TP that Z is ready to pay is 30 minus 3, 27. Maximum TP Z is ready to pay becomes 27. So both the divisions have different maximum TP here. Further, again something new important here. X wants to fix uniform transfer price. Uniform transfer price for both X, for both Y and Z. Now what does that mean? If they want to fix uniform transfer price for Y and Z, meaning they want to fix same transfer price for Y and Z. Look, Y is ready to pay maximum 32. I can charge 32 from Y. Z is ready to pay maximum 27. I can charge 27 from Z. But it is policy of my company to fix uniform transfer price for both. So the transfer price which I finally decide should be same for X and Y. Should be same for Y and Z. So uniform transfer price meaning I should charge same TP for both. If I have to charge same TP for both, I can say therefore I will decide transfer price as 32 or 27. Look, if I decide 32, then Y is ready to pay 32. But Z is not ready to pay 32 because maximum that Z is ready to pay is only 27. So no option, I have to choose transfer price of maximum 27. Because if I keep transfer price of 27, is division Z ready to pay 27? Yes. Division Y is ready to pay 27? Definitely. Hence, transfer price decided will be 27. I will consider transfer price of 27 while taking my divisional decisions. Done? Yes. So take transfer price equals to 27. Therefore, take transfer price equals to 27 for the divisional decisions. For the decisions from the viewpoint of each division, you will consider that the division is getting transfer at 27 rupees. Done? Yes. Okay. Further, required. They are just asking you recommend the best strategy for each division and company as a whole. Now, what are the recommendation that they require here? Well, now if you notice, the question involves basically two kinds of decisions. This question involves two kinds of decisions. Number one, whether transfer should be done or not, and number two, whether expansion should be done or not. Yes, so we will answer both the ways. We will answer whether transfer should be done or not, and we will also answer whether expansion should be done or not, because for every division, if expansion is done, then they will incur extra fixed cost, but they will also get extra contribution. We will answer whether they should do expansion or not. We will answer that for each division and for company as a whole. We'll answer that from divisional viewpoint as well as from company viewpoint. Both ways I will answer. Yeah. So chalo, for this question, I will draft my solution on a separate page over here. That is question 4C. But for that, I'll just write some summary of question here first. Three divisions you have X, Y and Z. Presently they are operating at 60%, 80%, 100%. At 60%, presently they are producing, X is producing 9,000 units, Y is currently producing 4,000 units, and Z is currently producing 2,500 units. Also, you are given in the question is variable cost of each division. X is having 18, Y is having, have to see the question again. Y has variable cost of 36 and Z has variable cost of 49. Okay. Now, based on this, I can say therefore this 18 variable cost of X is in a way minimum TP, because X is currently having spare capacity. Yes, its external sales is already done, still it is having spare capacity. So minimum TP that X will want is 18, and maximum TP that they are ready to pay, maximum TP that Y is ready to pay, we found out is 32. Maximum TP that Z is ready to pay, we found out is 27. Now forget that what is the TP finally decided. Finally decided was 27. Agreed. Leave it aside. Based on minimum TP, maximum TP, can I at least say that yes, transfer should be done? Yeah. Also, based on minimum TP, maximum TP, I can also say that the benefit of transfer to the company as a whole. Yaad karo, we have discussed this in our class, that what is the benefit of transfer to the company as a whole. Benefit of transfer is the difference of maximum TP, minimum TP. So when X transfers to Y, if X transfers to Y, then benefit of transfer to the company will be 32 minus 18, 14 rupees. And when X transfers to Z, benefit of transfer is maximum TP minus minimum TP, that is 9 rupees per unit. So think about it. What is more beneficial to company? For company, is it more beneficial to transfer from X to Y, or is it more beneficial to transfer from X to Z? Which is more beneficial to the company? As of now, it seems that transferring from X to Y is more beneficial, because otherwise Y will have to buy from outside at 32 rupees, while for Z it is costing effectively only 27. Yes, from the viewpoint of company, it is more beneficial to transfer from X to Y, but it is also beneficial to transfer from X to Z. Both the cases transfer is beneficial. In both the cases, if the benefit of transfer is positive, hence I say conclusion, therefore transfer must be done. Look, this question solution that now I am giving is very much different than the one I gave you in class. That is why I said this question is very typical. In class, what we did was a very long detailed solution. Here in the given question, such detailed one is not needed. So notice how am I answering. Plus, when you answer this question, this calculation work which I am showing is not very important. What is more important is your analysis. What is more important are the words that I am speaking. Concentrate on that better. I'll say therefore transfer must be done for the current level. Therefore transfer must be done for current level of production. Yeah, I'm not commenting on whether expansion should be done or not. Expansion decision I will still take later. First, I'm just taking a decision that for the current level of production, transfer must be done out of spare capacity. Yes, so X is able to fulfill its outside demand 7,500 units. Balance it will use in transfer. Yep. Transfer must be done for the current level of production, and first you transfer from X to Y. Then if any production remains, you transfer from X to Z, because transferring from X to Y appears to be having more net benefit to the company. Done? Yes. So this is my first analysis. Further, this is my first set of discussion. I'll just name that as 1. Further, we also talk about expansion decision. Expansion decision from the division viewpoint. And then I'll also discuss expansion decision from the overall company viewpoint. Expansion decision from the viewpoint of each division. From each division viewpoint, first of all, I'll say that the decided transfer price is 27 per unit, because the company has a policy to have uniform transfer price. For transfer from X to Y or from X to Z, both the transfer should have uniform transfer price of 27. So assume that they decided transfer price of 27. Now at this transfer price, now expansion decision. Expansion decision for Z. For Z, I can simply say that Z does not have any scope of expansion. Z is already operating at 100% level and they cannot expand beyond 100%. So for Z, I say no scope of expansion. So forget about it. For Y, I need to check whether expansion is suitable or not. If Y will do expansion, then how much extra units can it sell? Presently, Y is operating at 80% level and presently it is selling 4,000 units. If expansion is done, then how much extra units can it sell? From 80% it can expand to 100%. Y can sell up to 1,000 units more, because as per the question, your maximum demand of Y is 5,000 units. Currently you are selling only 4,000, so 1,000 more you can sell, and that 1,000 more will make your capacity 100%. Done? Yes. So if Y will do expansion, or Y if expansion is done, then how much extra units can they sell? Y can sell extra 1,000 units. 1,000 units extra can be sold, on which it will earn some contribution. What contribution will it earn? Well, on that 1,000 extra units, it will get selling price of 83 minus variable cost of 36. On that 1,000 extra units, it will get 83 rupees selling price minus 36 rupees variable cost and minus cost of X, material X. Yes, cost of material X. Now, assuming that division will obtain material X from division X, because division X also has spare capacity. So, minus 27 rupees transfer price of getting material from X. Let's see, are they getting extra contribution? 83 minus 36 minus 27 is 20 per unit into 1000 units, that is 20,000. 20,000 rupees is the extra contribution that they can get. But against that 20,000 extra contribution, they will also incur extra fixed cost, because as per the question, they said that for any expansion, they will incur extra fixed cost. As per the question, you will incur additional fixed cost of 9,000 for every 10% of capacity expansion. If Y will produce 1000 extra units, that is 20% extra capacity. And for 20% extra capacity, it will incur 9,000 two times extra fixed cost. It will incur is 9,000 into 2. 18,000 extra fixed cost, 20,000 extra contribution, 18,000 extra fixed cost. Net benefit is still 2,000 positive. So should Y do expansion? Yes. Y should do expansion if it gets material from division X. Yeah. So I can say here, therefore, for division Y, expansion must be done. And for division X, look, you notice I am going in reverse order, because X is the supplier. X will supply based on what Y and Z require. Yeah. For division X, should expansion be done? Presently, X is already producing what? 9,000 units. If expansion is done, then how much extra units can it sell? Extra, it can sell 4,000. Okay. If expansion is done, X can sell 4,000 units extra, because its maximum capacity was 15,000. And to whom will he sell 4,000 extra units? Whom will he sell that 4,000 extra units? Well, can he sell extra 4,000 in external market? No, because external demand is already fulfilled in the present level. But he can sell extra 4,000 to Y and Z, because you notice that his external demand 7,500, spare capacity is therefore 7,500, and Y and Z will consume 5,000 plus 2,500. Y and Z together require total 7,500 units. Yeah, so entire spare capacity of X can be consumed by Y and Z. Whatever extra 4,000 X will now produce, it can be taken by Y and Z. At what price will it be taken? 27. X can earn transfer price of 27 minus variable cost of 18. So it can earn 27 minus 18, 9 rupees on 4,000 units, that is 36,000 rupees. Okay, it's not 4,000, it is 6,000, my mistake. Spare capacity in X right now is 6,000 units. Look, presently it is at 60%, 9,000 is the production. Full capacity of X was 15,000. So spare capacity in X is 6,000. Entire 6,000 of X can be taken by Y and Z at uniform transfer price of 27. Yeah. So 27 minus 18, 9 rupees into 6,000 units, 54,000 rupees extra contribution he can get. 54,000 extra contribution X can get, against which he will incur extra fixed cost of how much? Well, if he will use entire remaining capacity, presently they are already operating at 60%. If he will use entire remaining capacity of 40%, that is 10%, 10%, 10%, 4 times. He will incur fixed cost 9,000, 9,000, 4 times. Extra fixed cost will be rupees 9,000, 4 times. That is 36,000. Still there is net benefit. 54 minus 36,000. Still 18,000. Net benefit remains. I'll say therefore expansion must be done in division X also. Done. This is my decision, this is my answer from the viewpoint of each division. Now last answer, expansion decision from the viewpoint of company. Not more now it's simple. Expansion decision from the company viewpoint. So from the company viewpoint, imagine that if X and Y both will do expansion, then what happens? Well, from company viewpoint, if expansion is done, then transfer from X to Y. For transfer from X to Y, because if expansion is done, then extra units will be transferred from X to Y. Extra units will also be transferred from X to Z. Yes, so from company viewpoint, for transfer from X to Y, net benefit of transfer from X to Y was how much? For transfer from X to Y, net benefit was rupees 14 per unit. On how many units? Well, X is already producing 9,000 units at present. X is presently producing 9,000 units, from which 7,500 is already going for external sale. Yes, and balance 9,000 minus 7,500, balance 1,500 X is presently doing transfer. To whom? Assume that presently X is transferring to Y, because transfer to Y is more beneficial. So presently X is already transferring 1,500 to Y. Now if Y will operate at 5,000 units, so Y will require 3,500 more. That 3,500 is new transfer because of expansion. So if expansion is done, then transfer from X to Y will increase by another 3,500 units. Is extra transfer. So net benefit on that, 14 into 3,500 is 49,000. And transfer from X to Z. Look, X was operating at 9,000 units. If expansion is done, it can produce 6,000 more. Out of 6,000 more, 3,500 it will transfer to Y, and balance 2,500 extra transfer is done to Z, because Z was not given any transfer right now. Now if I will give 2,500 extra transfer to Z, then net benefit to company, net benefit to the company for this will be 9 rupees per transfer into 2,500. 9 into 2500 is 22,500. Total net benefit to company is 71,500. But against that, company will have to incur extra cost of extra fixed cost of expansion minus extra fixed cost of expansion in division X and division Y. Extra fixed cost of expansion in division X they will incur is 9,000 rupees into 4 times, and division Y you will incur 9,000 rupees 2 times. Yeah, so total extra cost 36,000 and 18,000. Still there is net benefit from the company viewpoint, still net benefit of 17,500. So decision from company viewpoint, both the expansion should be done. Yes, so my decision therefore expansion of X and Y both must be done, and X must do 7,500 units external sale, 5,000 units transfer to Y, and 2,500 units transfer to Z, because everything X can fulfill if it can do expansion. Done? Yes? Yeah. So that is your question 4C. I told you, look, this question is the only typical question in the paper. This is my suggested solution here. However, this question is, look, this question is a very open-ended question. So for this question, there can be more than one possible ways of answering the question. There can be more than one ways of explaining this decision. Ultimately, decision is this. Ultimately, no matter how you explain, your final decision will be this, that both the expansions should be done and X should operate at full capacity, transferring everything, fulfilling entire external demand as well as transferring remaining spare capacity to both the other divisions. That is the ultimate decision. It doesn't matter how you explain your answer. It doesn't matter what kind of net benefit you explain, as long as your final decision is this. Done? Yes, that is question 4C. Going further, next question 5. Question 5A and question 6, almost we are done. Question 5A, let's see. Question 5A is from chapter 4. It's again directly from my book, page 4.34, question 7. You will see it is a question of life cycle costing. Exact same copy paste question we have in our book. Yeah, exact same copy paste question. I'll show you the solution here itself. Scmpe International has developed ultra modern smart LED TV with latest features. It has been developed after extensive research and is ready for manufacturing. The firm has incurred 6,50,000 as development cost. Has incurred development cost. Well, I'll say this becomes your sunk cost. Has incurred 6,50,000 as development cost. I'll say that is sunk cost. So ignore that cost. The firm is deciding on a plant capacity which would cost 40 lakhs for manufacturing 600 units with an additional outlay of 40%. Additional outlay, additional capital investment of 40%, then capacity can be increased by 50%. In short, they have two options. Option 1, you purchase plant of 40 lakhs. Option 2, you purchase plant of 40 plus 40%, that is 40 lakhs plus 40%, 56 lakhs. Yeah. Option 1, let me just write the options here. Option 1, you purchase 40 lakhs plant, 40 lakh rupees ka plant. Option 2 is that you purchase plant costing 40 lakhs plus 40%, 56 lakh cost plant you purchase. If you purchase 40 lakh plant, it will produce 600 units, and if you purchase 56 lakh costing plant, it can increase the capacity by 50%, so that can produce 900 units. And look, this 600 units that you are mentioned, does it say 600 units per annum? No. So consider that this 600 units is lifetime. It doesn't say per annum, and anyways the question is about life cycle, so consider that 600 units is lifetime units. The relevant data pertaining to life cycle at different capacity levels is as under. You are given now other data here. You are given selling price per unit in option 1, option 2. Look, both options, 600 units, 900 units, and you see that if I want to sell 900 units in lifetime, then I need to charge lesser price. Simple law of demand. Yep. Variable selling cost you are given, salvage value of plant is given, and PV ratio is given. Look, PV ratio is given common between both options. This was different than my classwork question. In my classwork question, I gave you PV ratio of only option 1, based on which PV ratio of option 2 you had to find. But this time PV ratio is already given common between both options. Good enough, your work is easier. Advise the company regarding optimal plant capacity to install. The LED TV's life cycle is 2 years, and ignore time value of money. Look, whenever the question is about life cycle, they will always say ignore time value of money. Here also, okay, you ignore TVM, and let us identify that whether option 1, option 2, which is more profitable. Chalo. Based on this, I can identify contribution per unit. In option 1, contribution is 45,000 into 30%, 13,500. Option 2, contribution per unit 41,400 into 30% into same 30% is 12,420. Therefore, total contribution option 1, 600 into 13,500 is 81 lakhs, and option 2, 900 units into 12,420 is 111.78 lakhs. Total contribution you have. And are you given any fixed cost per annum? No, forget it. Directly lifetime profit you find, lifetime profit. So from this, minus the plant cost. For option 1, you will have to spend 40 lakhs in purchasing the plant. Option 2, you spent 56 lakhs in purchasing the plant. Okay, but in each option you also get scrap value of plant at the end. What is the scrap value we are getting in option 1? In option 1, we are getting scrap value 20% of the plant cost. Option 2 also we are getting scrap value 20% of plant cost. So option 1, scrap value is 20% of 40 lakhs, 8 lakhs. Scrap value we are earning, so positive. And option 2, you are earning 20% of 56 lakhs. 56 into 20%, 11.2 lakhs. That gives me lifetime profit. Only 3 items like this. 81 minus 40 plus 8 is 49 lakhs. Lifetime profit. And option 2, 111.78 minus 56 lakhs plus 11.2 lakhs is 66.98. Which option is better? Option 2 is better. Done? Yes, this is your answer to question 5A. Further, 5B. Next question, question 5B, and 5B is basically a case study. It is a kind of theory case study for interpretation of variance and critical success factor. And this is also exactly from my book. Only difference is that this is exact opposite. Like the variances that you had in my book were, say, favorable variances, and you were supposed to interpret those favorable variances. The variances that you are given in this case is exactly opposite. It is exactly adverse, and you need to write interpretation for that accordingly. Yeah. So for this question, I will not write down any answer because it is purely interpretation based question. Read the question and I will speak out the interpretation. Listen carefully. Let's read. Osaka Tea Company manufactures and distributes finest quality black tea to hotels, restaurants and retailers. The company has a wide presence in tea market. It has become one of the largest premium brands. The customers are also very happy with the finest quality of tea. So you notice repeatedly they are focusing on finest quality of tea, premium brand, finest quality black tea. So the company is mainly focusing on producing the best quality of tea. Yeah. Plus they say they never compromise with the quality of the tea. The aim of the company is to deliver finest black tea. Aim is to deliver finest black tea to keep the customers happy. It has tied up with big tea estates for procurement of finest tea leaves directly from the estate for processing in its own plant. The tea leaves go through various processes like plucking, withering, blah 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 blah. These are then packed in beautiful plastic jars for distribution to hotels, restaurants and retailers. Okay. During the meeting of management, it has been decided to reduce price per kg. The management decided to reduce price per kg by 5% to increase the volume of sales. Now this is the main issue here. The management decided to decrease the price in order to increase the volume. Now that is a basic law of demand, that if you charge lesser price, then your quantity should decrease. If you charge lesser price, then your quantity should increase, demand should increase. That is what they are targeting. They decided to reduce the price per kg by 5% so that the volume is increased. Okay. The following variances pertain to last month's operations arose as a consequence of implementation of above decision. What did they decide? They decided to reduce the selling price. Now think, if they reduce selling price, if they decide to reduce the price, I can say therefore sales price variance should come adverse. Because if they charge lesser price, then to that extent sales will decrease. Yeah, but because of lesser price, they expect to have increase in volume. So therefore sales volume variance should come positive. Yes, let's see what variances did they get. Notice, yes, they are getting sales price variance adverse because the price is decreased. Yes, they are getting sales volume variance favorable because volume will increase. But if you notice the overall impact of that sales volume variance, net effect gives me total sales variance. Net effect should give me total sales variance, and you notice that my sales price variance is 24,500 adverse, while volume variance is favorable, but it is only 20,600 favorable. So net effect, my total sales has decreased. 24,500 adverse and 20,600 favorable. Net effect, my total sales variance has decreased my total sales has decreased 3,900 adverse. Now that itself gives me one interpretation that my proposal, that the management proposal of decreasing the price has not given a positive impact. The management proposal, management thought that if we decrease the price, then volume will increase rapidly. Management thought that if we decrease the price by 5%, then there will be tremendous increase in volume so that my company will benefit as a whole. Did they benefit as a whole? No. By decreasing the price, they lost the sales 24,500, but by increase in volume, they gained extra only 20,600. Net effect, total sales decreased. Even purchase price variance adverse, even labor efficiency variance adverse, even fixed cost expenditure variance adverse. This means purchase price variance adverse. It means what? It means purchase became more expensive. Labor efficiency variance adverse. It means labor have become inefficient. Labor efficiency decreased. And fixed cost expenditure variance. Expenditure variance means budget variance. It means fixed cost also increased. So it seems that the decision that the management took, the management decision of decreasing selling price, has given more adverse than favorable. So is that a good decision the management took? No. This is what we need to comment. Check out your required part. Identify critical success factor of the company. What is critical success factor of this company? Which ability of the company defines success of the company? Is this company focusing on low price penetration pricing? No. This company is selling the finest quality tea. This company is selling the finest quality of the tea and they are a premium brand. They never compromise on quality. All these sentences give you an idea that the most critical success factor of the company is quality. Maintaining premium quality is the success factor of the company. So what is the CSF, critical success factor of the company? Critical success factor of this company is quality. Their main method of selling the product is quality, not the price. Yep. And evaluate management's decision with overall corporate strategy and critical success factor. Well, I evaluate here that if the most important factor of the company is to promote quality, then the management decision of reducing the price is a wrong decision. Because if the company is focusing on good quality, then naturally the customers of the company are not price sensitive. If the critical success factor of the company is quality, meaning all my customers are buying my product not because my product is cheap. My customers are buying my product because it is good quality product. So by decreasing the price, increasing the price, my customers will not be affected as long as my quality remains the same. Yes, so the first thing that I write here is that success factor, CSF of the company is quality. Then why is the management trying to decrease the price? My customers are not price sensitive. If it was price sensitive, meaning by decreasing price, if I decrease price slightly also, then also my quantity will increase rapidly. But that is not the case here, meaning my product is not price sensitive. So it was a wrong decision to decrease the price. Because of decreasing price, the quality might have also deteriorated. My quality also might have deteriorated. That is why the volume did not increase significantly. Yeah. So due to less price, maybe quality also deteriorated, and that is why every variance is going adverse. Yes, plus you also write these interpretations that because of management decision my purchase have become more expensive, my labor has become inefficient, and my fixed cost has also increased. Hence conclusion, management decision to decrease the price was not a very good decision here. Done. Yes, you notice here that question 1 is only 1 mark, but question 2, this entire analysis is carrying 9 marks there. That is the biggest answer here. Done. Yes. Okay, that is question 5b. Going further, question 6a. Question 6a is a new kind of question that is pertaining to labor strike, and well, I told you in my previous video, this question is as such new in my book, but it was already a part of my old book. So those students who have my old book will have that same question in your chapter 6. But anyways, unfortunately I removed it in the latest material, and unfortunately it just got asked here. But it's a very simple question, I'll show you here. It's regarding workers going on a strike. Let's see. Yes, we'll discuss question 6. Zyna Private Limited is a manufacturing company of electrical equipment. The company is facing possibility of a strike by its direct production workers engaged on the assembly of one of its machines. The trade union is demanding an increase of 8%, backdated since the beginning of the financial year, but the company expects that if a strike does take place, it will last for 4 weeks, after which the union will settle for increase of only 6%, similarly backdated. What is the situation here? It seems that the company has two options. Option 1 is that I agree to whatever the union is demanding. Union is demanding what? Union is demanding 8% increase in wages. So option 1 is that I agree whatever they demand, and accordingly I pay them 8% extra wages. Yeah. Or option 2 is that initially I don't agree to what they demand. If I don't agree for 8% increase, then the workers will go on a strike. If they go on a strike, then the strike will last for 4 weeks. After 4 weeks, they will settle for an increase of only 6%. So if I let them go on a strike, then I need to pay only 6% more wages. If I don't want them to go on strike, I need to pay 8% more wages. Which is better? Well, we need to decide which is better based on calculations. Look, if I agree to what they demand, then I simply pay them 8% extra. That's it. But if I don't agree, then they will go on a strike, and after 4 weeks of strike, after living 4 weeks without salary, then they will agree for only 6% increase. So that is good for me that I have to pay only 6% increase, but in that case 4 weeks production I will lose. If they go on strike for 4 weeks, then I will lose production of that 4 weeks. That is the problem. Yeah. Further, the machine whose production would be affected is ceiling fans. So your company is manufacturing ceiling fans. The machine whose production would be affected by the strike is sold to distributors at a discount of 25% from the current recommended selling price of 2000. Okay. So effectively I can say, therefore, selling price is 2000 minus 25%, that is 1500. 1500 is the selling price of your product. The estimated cost of that ceiling fans are given here. You are given production cost 1200 variable, 800 variable is distribution cost, and fixed cost is production 8 lakhs and distribution 3 lakhs. Total variable cost 1280. Further, the direct labor comprises 60% of variable production cost. Look, out of this variable production cost, which is variable production cost 1200, out of that 1200, 60% is labor cost. Why have they mentioned labor cost separately? Well, they have to mention labor cost separately, because if I plan to increase wages by 8%, it will be 8% increase in the labor cost. Yeah. So what is the labor cost? Labor cost is 60% of variable production cost. I mentioned that here. That is 60% of 1200. 1200 into 60%, that is 720. This means that this variable cost that you are given here, these variable cost includes rupees 720 labor cost. It includes 720 rupees labor cost, and accordingly it also means that if the union is demanding increase of 8%, so increase of 8% means 8% of 720. 720 into 8%, that is 57.6 per unit, is the increase that they are demanding. $57.6 per unit is the increase they are demanding. But if I allow them to go on a strike, then after 4 weeks of strike, then I will have to pay increase of only 6%. That is 720 into 6%. Then I will have to pay increase of only 43.2 extra labor I will have to pay. Done? Okay. So that is why you were given the labor cost here, 720. Further, the budgeted output is 30,000 units in 50 working weeks per year. This is your budgeted output. But if strike will happen, then 4 weeks your workers are not working. So out of 50 week production, 4 week production you will lose. Yes. If strike takes place, then following situations are expected by the company. Now they have told that if strike will happen, then what happens? Let's see. If there is a strike, then maintenance staff. Now maintenance staff is different than the ones who are asking increase. Maintenance staff whose wages are included in the fixed production cost. Maintenance staff wages are included in this fixed production cost. That maintenance staff would be used to carry out an overhaul of the conveyor system using materials worth rupees 50,000. This work would otherwise be undertaken by an outside contractor at a cost including materials of 1,50,000. Now what does this mean? Well, this means that if strike does take place, if there is a strike, then your production is stopped. Your production workers are going on a strike. Then during the strike period, what will your maintenance staff do? If the production staff has gone on strike, then maintenance staff is sitting free. So during that free time, they can do overhaul of the conveyor system, which was otherwise being done by outside contractor at rupees 1,50,000. So I can say because of strike, I will have savings in overhaul cost. Because of the strike, I will save overhaul cost of 1,50,000. But for doing that overhaul, I will have to spend materials worth rupees 50,000. So net savings is 150 minus 50. Savings in overhaul cost is equal to 150 minus 50, that is 1 lakh is my savings in overhaul cost if the strike is done, if the strike happens. Look, apparently in this question there are two options. Let me first list down the options. Say option 1, is that I agree to the worker demand. Therefore, no strike. And option 2 is that I don't agree to the workers' demand. They are demanding 8% increase. I strictly said no, 8% definitely I will not increase. If I don't agree to the worker demand, then there will be a strike. And after a strike, we will settle for 6% increase. Yeah. So basically 2 options in the question. And this overall savings that I will get, the savings and overall cost that I will get, I will get that in which option? I will get that in option 2. Yeah. In option 2, that is if strike takes place. If strike takes place, that is option 2. Further, again in option 2, sale of 500 ceiling fans would be lost to competition. Now look, how many weeks did the strike last? The strike happened for 4 weeks. My annual production is 30,000 in 50 weeks. If 30,000 is production in 50 weeks, therefore production of 4-week strike period would have been how much? If 30,000 is production of 50 weeks, then 30,000 into 4 by 50. My production during strike period should have been 2,400 units during 4 weeks of strike. Now if 4 weeks the workers were on strike, they were not working, then 2,400 units I must have lost. I should have lost 2,400 units, but this sentence here says that only 500 units were lost. Why? Read further. The balance that could be ordinarily been produced during the strike period could however be sold. Remaining units were possible to sell. How? Well, were possible to sell because these units would have to be produced in overtime working. Okay, now that makes sense, that if 4 weeks the workers were on strike, then after the strike, when I agree to pay them 6% extra, I also put a condition that you will have to work overtime and try to recover the lost sales. How much would have been the total lost sales? 2,400, from which actually lost was only 500. So the balance will be 2,400 minus 500, that is 1900 units. The balance 1900 units were produced in overtime working. Balance 1900 units were produced in overtime working. Yes. And because it is during overtime, you are given that will be produced in overtime working, during which efficiency rating of only 80% is achieved. Only 80% efficiency was there. This would also entail additional fixed costs of 40,000 due to overtime, and wage payments at time and half. Wage payments at time and half, meaning 50% overtime premium. All that we will incorporate in our workings. Yeah. And required, you are supposed to calculate profit or loss with and without strike. Profit or loss with and without strike. Let me show you that working separately here. That is question 6a. First part, I will calculate profit without strike, because without strike was my option 1. Don't allow them to go for strike. Agree whatever demand they are giving. Profit without strike, that is option 1. Okay, so in that case, what will be my profit? Let us first calculate the contribution. My basic original contribution was what? My basic original contribution will be like this. 30,000 units is what I sell annually, and if my workers don't go on strike, then I will continue to sell all 30,000 units. Yeah, and on that 30,000 units, what is the selling price that I am getting? I'll show that here. The selling price that I am getting is selling price that I am getting is 1,500, and my basic variable cost is 1280. Let me write down contribution here itself. Selling price 1,500, total variable cost 1280. Therefore, contribution per unit is 1,500 minus 1280 is 220. This is my existing contribution per unit. Now, over here, if I don't let them go on a strike, meaning I agree to pay the extra wages that they demanded. If I agree to pay the extra wages, then my contribution will decrease. 220 was supposed to be my contribution, but how much extra wages did they demand? They demanded extra wages of 57.6 per unit. I agree to pay that much extra, then my contribution will decrease by 57.6 per unit. Makes my total contribution 220 minus 57.6 into 30,000, 48,72,000. Contribution minus fixed cost. Fixed cost, as per the question, it's already given, is 8 lakhs, 3 lakhs, total 11 lakhs is the fixed cost. Put that here, fixed cost of 11 lakhs. Gives me profit of this option. $37,72,000 is the profit if I don't allow them to go on strike. Profit of option 1. Then option 2, profit with strike. Again, for that contribution first. Now I will split my contribution into 2 parts, because there are some units that I sold during the strike period and remaining units I sold in the non-strike period. Yeah, let's see. So for the non-strike period, non-strike period is 46 weeks. Out of 50 weeks, 4 weeks was the strike period, during which I lost some sales, but during remaining 46 weeks, I did not lose any sales. What is my sales of 46 weeks? 30,000 into 46 divided by 50 is 27,600 units. So during these non-strike period, I have 27,600 units on which what contribution do I get? On which I get contribution 220 minus, look, in case of option 2, if strike will happen, then after the strike, do I need to pay them 57.6 per unit extra? No. If strike will happen, then after the strike they will settle for only 6% increase. I need to pay only 43.2 per unit extra. Yep. So I need to pay only 43.2 per unit extra. So only that much contribution will decrease. So from original contribution 220 minus 43.2, I paid extra on 27,600 units, gives me total contribution 48,79,680. 48,79,680. Yeah, now this is my contribution during the non-strike period. Plus I also get at least some contribution during the strike period. Strike period is of 4 weeks. So proportionately for 4 weeks, during that 4 weeks, my sales should have been 2,400 units. But because of strike, I could not do sales of 2,400 units. Out of 2,400 units, I lost only 500 units sales. I lost. I did not lose sales of entire 2,400. I lost only 500 units sale during the strike period. Remaining balance, what is the difference? 1900. The remaining 1900 units I was able to sell, but that I was able to sell by working overtime. And because of overtime, I had to pay extra wages, plus I had to pay overtime premium, plus there was a lack of less efficiency also. What is the extra cost during this time? We need to find out. On that, I earn a contribution of 220 minus the extra cost. Now, what is extra cost during this time? I need a working note for that. Extra labor cost per unit during strike period overtime. Extra labor cost per unit during strike period overtime. So during this period, what is the new labor cost that I must have paid? During this period, the new labor cost that I must have paid is original 720 plus 6% increase that I agreed, plus 50% overtime premium, yes, and divide by 80% inefficiency. You remember I have taught you earlier that whenever there is change of efficiency, all you need to do is divide the new efficiency. I simply did that here. Yeah. So let's try this. 720 plus 6% extra for the strike that I agreed, plus 50% extra for overtime premium, and divide by 80% makes it 1431. Makes that 1431. That is my new labor cost minus old labor cost. Original labor cost was 720 original. What is extra labor cost? $1,431 minus 720. Extra labor cost is 711. And this extra labor cost 711 is what I show here. So during the strike period, if I had to pay 711 rupees extra labor cost, so that wiped out my entire contribution it made my contribution negative. 220 minus 711, 220 minus 711, negative 491 is my contribution on these 1900 units, 1900. So 9,32,900 rupees I lost. Might as well I should not have forced my workers to do overtime. Because of overtime, I am losing 9,32,900 rupees. Negative contribution I am getting. If I did not ask them to work overtime, might as well let that contribution be lost. At least I won't get negative contribution. But this is what the company has done. So we work out that 9,32,900 negative contribution. Apart from that, under this option 2, which other changes have happened? Under this option 2, chalo, this was my contribution aspect. Also under option 2, I will continue to incur fixed cost. Let's say same fixed cost of 11 lakhs. But I have one savings in overhaul cost. Net savings of 1 lakh. Net savings in overall cost is 1 lakh, and there is additional fixed cost. And there is additional fixed cost later given for overtime, 40,000. Let's see what profit do we get. Profit that I get is 29,06,780. Now this is my answer. Profit with strike, profit without strike. Chalo, that is my answer to the first question, which says calculate profit with and without strike. Okay. Now based on this answer, taking purely economic point of view, only financial factors, considering only financial factors, advise the management to allow the strike to go ahead rather than agree to the union's demand. What will be your advice? Now you see that if you allow the strike to go ahead, then your profit is 29 lakhs something. But if you don't allow the strike, rather you agree to the demand, if you agree to the workers' demand, then your profit is 37 lakhs. There's a huge difference. What is my advice? My advice is that you should agree to the workers' demand. You agree to the workers' demand and pay them whatever extra they are demanding, because if you don't pay them extra, then there is lesser profit here. Done? Yes. So my answer here is that company should agree to union's demand. And thirdly, they are asking list any 2 factors not considered in your above evaluation that may have adverse financial effect for the company if the strike were to take place. Well, simple. Which other adverse impact will happen if strike will take place? As of now, you already see that if strike takes place, there is adverse profit. But if strike takes place, what else adverse can happen? Well, if strike takes place, the biggest problem is the reputation of the company. If there is strike in the company, in the market, the news will go that there is strike in the company. So number one, you might lose out on customers, because anyways, these 500 units that you lost, competitors, your your customers have gone to competitors. If customers like the competitors, then more customers will go to the competitor. Yes, so loss of sales means loss of brand value. Plus, secondly, if there is news in the market that the workers in my company are on strike, then in future it will be difficult for me to get more workers also. No, none of the employees, none of the prospective employees will be willing to work in my company because the employees saw that my company workers are going on strike. Yes, so these are like two other considerations, non-financial considerations that you may answer. Done? Yes. Okay, so that was question 6A, and that takes us to my final question. Finally, look, you noticed that this paper had most of questions out of our discussions only, not many things new here. But however, I agree that the paper was pretty long. In fact, every paper of costing will always be long. You might feel that this paper was long because maybe this is the paper that you attempted in the exam. You ask your seniors, costing papers are always very long. Costing papers will always be long. You have to speed up writing your papers. Yeah. Anyways, last question let us discuss. Question 6B, that is from chapter 12, variance calculation. It is a simple question for interpretation of variances. 10 marks question, practical question, and it is exactly same as my book, page 12.3, question number 5. Let's see. Company manufactures single product and standard costing system is followed. Standard cost per unit is calculated as below. You are given details of standard cost for material, labor and variable overheads. Well, actually, you don't need so much details. Actually, the question is asking you to calculate only labor rate variance and labor efficiency variance. Labor rate variance, we called it LRV, and labor efficiency variance, also called as labor time variance. Only labor variance is what they are asking. Well, if only labor variance they are asking, then you don't need details about material and variable overheads. You require details about only labor. And all that details actually you are already having over here. Budgeted units 15,000, actual units 13,800. I can make a column here. Standard for actual. Standard for actual, if 15,000 budgeted units require 75,000 hours, then standard I should make for 13,800 units, and let's see it will require how many hours. 15,000 units require 75,000 labor hours, then 13,800 units will require what? 75,000 divided by 15,000 into 13,800 makes it 69,000 hours. Standard hours 69,000 hours at 9 rupees rate. That becomes my standard. So now you just have to calculate a variance using standard 69,000 hours at 9 rupees, and actual is this. Actual also rate you can identify. Actual cost 569,600 is the total cost for 71,200 hours. So rate is what? 569,600 divided by 71,200. It turns out to be rate 8 rupees per hour. हो गया. You can calculate LRV LTV here. Labor rate variance. याद करो, your formula for rate variance will ask you to take actual hours 71,200 into standard rate 9 minus actual rate 8. That gives you positive 71,200 rate variance. Yes, you have saved the rate, so your rate variance is positive 71,200, and your time variance formula yaad karo, it is standard rate 9 rupees into standard hours 69,000 minus actual hours 71,200. 69,000 minus 71,200 into 9 rupees is 19,800 adverse. That is your calculation part, and you notice calculation of variances is giving you only 3 marks. more marks is for interpretation of result, and that interpretation I can say is exactly same as page 12.13 question number 5. This I had explained you in class. In fact, I'd even made you write some guidelines for writing variance interpretation, and guidelines of variance interpretation also given in your class notes are very important. Exactly same guidelines you follow for this interpretation. Same interpretation. What will I interpret here? So I'll just discuss orally, but if you want the writing, you can see the book. I'll say that labor rate variance is favorable. It means that I have paid lesser rate of labor. It means that I have paid lesser rate in labor, but my efficiency variance is adverse. Efficiency variance is adverse means that my workers took more time to do the production. Now, what will be the reason for this? Well, I can give a cross-reference reason here. My rate variance is favorable, meaning I saved the rate, I paid lesser rate to my workers. Maybe that is why my workers have become less efficient. My workers' efficiency has decreased because I paid a lesser rate. That can be one of the reasons. Or maybe my rate variance is favorable because the standard rate which I had taken here itself was illogical, itself was wrong. Actual rate that I paid 8 rupees, but standard rate that I have written 9 rupees, that standard rate itself was unnecessarily set very high. Maybe that is why my rate variance appears favorable. Same I can tell for efficiency also. My efficiency variance appears adverse. It means that my workers have taken more time to do the production, but it may also be because my standard time decided here 69,000 itself was wrong. My standard time decided was unnecessarily set very low. Maybe that is why efficiency variance comes adverse. Yeah, remember I have told you that whenever you write interpretation of variances, you write interpretation exactly as per the meaning of the variance, plus you also give reasons for that variance. You give possible reasons for that variance. One of the reason can be that the standards were wrong. Another reason can be that you have made mistake in actual. Yes, both side reasons I explained here. You can see that on page 12.13. Done? Yes. So that completes my question. That completes your discussion of November 20 ICAI paper Scmpe subject. Yeah. So overall, I can say that the paper was pretty good. In fact, the paper was very easy. But only problem was that yes, while answering the paper, you might have experienced that the paper was pretty long. So those of you who did not experience answering the paper, looking at my discussion here, you might feel that the paper was very easy. Apparently, yes, it was. But you know, during the exam, your outlook to the paper will be completely different. Right now, analyzing the paper, it seems to be very easy. But when you get the paper during the exam, trust me, it appears very difficult. Plus, during the exam, you have to read the question, you have to give your thought process, you have to do interpretations of question, then you start answering. It takes a lot of time. Yes, so majority of the students who appeared for this exam might have felt that the paper was very long. So the only request to the future students is that yes, you make your preparations very well, but when you start answering the paper, please keep a track of time. Please speed up in answering the paper, because yes, costing papers are always very lengthy. Done? Yes. Well, that's all from my side. I hope you understood the entire paper, and I hope that helps the students who are giving exams in future. That's all. Thank you very much. Bye bye.